Good morning and welcome to Simple Steps for Starting Your New Business number 5. This is the day that we help you understand where you can get the money. Show me the money, and we will give you some great hints. This webinar is being recorded, and the presentation and a link to the video will be emailed to you. That should help you a lot with your sense of having to write down every link. The links that we suggest to you will be hyperlinks. They will be embedded in the presentation. If you have a question, when you have the question, please type it into the chat. At the end of the formal presentation, we will be answering your questions, and we will stay as long as we have questions. Thank you so much for your participation. It is great to have you with us. We want to run a poll just to help us make sure we cover everything you need to cover. Number 1, do you have an EIN? That stands for Employer Identification Number for your checking account and for your business. Number 2, do you know how much money you will need to start your business? Yes or no? Number 3, do you currently have a banker you're working with? And then number 4, do you know what type of financing you will need? Whether that is an SBA loan, a traditional loan, are you using crowdfunding? Are you going through a community development finance institution, CDFI? You don't need funding, meaning you're bootstrapping, or you just don't know. Check one of those, if you will. And we will be anxiously awaiting the results. Okay, 63% of you have filed for your EIN with the IRS. 38% of you know how much money you're going to need, and that's fine. 63% of you do not. That's why we're here. That's why we provide you mentors and this information. Do you currently have a banker you're working with? That's 50-50. And do you know what type of financing you will need? And it's fairly distributed over the options, and with 38% of you not knowing. So that's great. Thank you so much for sharing that. I want to introduce our participants. They're going to turn on their camera for a moment and wave at you. I'm Tom Sims. I'm a social and business entrepreneur and coach. Jaspreet is with us. She's also an entrepreneur and a businesswoman and a financial wizard. And Michael Moore is with us. He's a retired banker, and they may tell you a little bit more about themselves as we go through the process. We are SCORE. This is one of our signature programs, Simple Steps for Starting Your New Business. For those of you who've been through 5 of these sessions at the end of today and have done the homework, we have a certificate for you. Please get Christina and put it in the chat, if you will, directly to her, your email address, the name of we have your email address, but the name of your business and the name that you wish to appear on your certificate. We're going to have a little graduation ceremony at the end. And we are working with a number of community partners. You can see those here. And we are so happy for those of you who have made it. You have received a university level education in starting a new business. We also want to thank our partner, Union Bank, for making this process and this course available to you. It's always good to have a good partner. And when that partner is a banker, that's especially helpful. SCORE volunteers are successful and experienced business executives. We offer seminars and workshops. We offer you free mentoring. There is nothing that we do that is more important than teaming you up with a mentor who will meet with you as often as necessary to do one-on-ones, to walk you through all of this information, to help you develop a business plan, a marketing plan, a financial plan. And we normally meet online, but it is also, we're getting back to some in-person meetings. We contact you and you can contact us through emails, some of us through text. It's one-on-one. Sometimes we'll do groups, sometimes we'll do partner, but you need to go to www.centralvalley.score.org. If you're out of the area and you want to mentor in your area, you can go to score.org/find-mentor. If you would like to be mentored by one of us or one of our local mentors in the Fresno or Modesto area, you can go directly to the Central Valley SCORE website. Here's where we are. This is the process. This is the roadmap. Session 1 was Startup Basics, at which time we encouraged everyone to begin one-on-one mentoring. And then by the second session, after a homework session, we talked about the business concepts. And most of you made a go or no-go decision and began to take next steps with the mentoring. We started session 3. And along the way, we were mentoring, helping you build a business plan. We entered in last week to the financial matters context, and we began to talk about how you handle your day-to-day and month-to-month and year-to-year finances. And today, we're on funding options. This workshop is today to help you develop your feasibility plan. We're taking you through the decision-making process. We do this in every workshop, really. We've been providing you with information to help you make the go or no-go decision on your business idea, making sure you have the core information to create a complete business plan for bankers and investors, and giving you key directions that you need to get started. I'd like to turn this over to my esteemed colleague, Jaspreet Chawin.
Thank you, Tom, and thank you everybody for attending this workshop, number 5. And as we all know that funding is an important part of the business plan. There are many businesses, they fail because they don't have proper funding. They don't have proper financing plan for their business. So we are gonna give you lots of good information, like what fundings, that fundings and sources there are available for you as a small business owner to leverage. And so we're going to be talking about funding and sources, 6 C's of credit, what bankers want, borrowing strategies, and go and no-go decisions. Okay, thank you. So why businesses need funds? Well, there are many reasons a business might need funding. Number 1 could be a business wants to grow, they wants to increase their sales. So for that, maybe they have to open a new location, and maybe it's a new product they are trying to launch, or they are trying to increase their digital marketing. So they may need money for that. And the second reason could be increased production or service capabilities. Maybe a business trying to be more automated. They're needing more equipments. They're upgrading software technologies. Maybe they need more people, more labor, and they are gonna train additional staff. Replace a worn out delivery van. Maybe they have old vehicles for their business. Maybe it's a restaurant and they need more newer, vehicles because they were paying too many, repair and expenses, maintenance. And the third reason, boost profits. Maybe it's a business that was, a physical location, and now they want to be e-commerce. They want to be online. They take advantage of volume, purchase, discounts to lower cost. Some business, they do that, especially if it's a retail business. They will buy inventory, volumes if they are receiving discount from the supplier. So they may need more money for that. Or they want to increase staff productivity. Maybe they're trying to, trying to give incentives to their employees, or maybe offer them some good benefits and they need money for that, right? Or the fourth reason is manage cash engaged in the business. Maybe it's a business that have lots of problems. Maybe they have too many credit cards. They're confused. Maybe they're paying 25% or 30% interest on each. So they don't, they want to be like having one payment. So maybe they need money for that, so they can put everything together. Build inventory for busy seasons. Maybe it's, one of the store that they're, Christmas season's coming. So they need money for that. Handle seasonal cash requirements. Need money for that, right? Secure funds for one-time or unplanned expenses. It's a business. You might need money anytime. So it's unexpected things happen that we have already, ready planned to, take care of the needs. Okay, next one. Okay, so now this is in a template, and this is actually for you guys. And this will also be in your next, next week's homework. That's one of the assignments that as a business owner, if we are needing money, what are we trying to accomplish? If we need money for the business, what is the outcome? Are we trying to grow our business, improve our sales or increase the sales, increase production, boost profits, manage cash engaged in the business? Others, maybe we are opening a new business and we need funding for that. We maybe have only, maybe 25% of it. We need more 75% of the funding. So for here, this template, you can use this and you can answer these. And because next week we'll ask you more on these. So you can, say that you have the existing, you have funds, on your hand, or you're going to be needing to, apply for a loan. So this is a great worksheet that you could use for your business. Yeah. And next page, please. Okay, so what are the sources? Where to find funding? So there are many places that we can shop for our loans. Okay, so the sources for funds, on the left side, they are different types, and then we talk about what is the positive, points, and what is the negatives, pro and cons. Okay, so business cash reserves, that's money that you've been saving, for your business. It's inexpensive, low risk source of funds. It's a flexibility. Use profits and retain control of the business because you have saved up money. So you don't need to borrow from anybody. That's your money. So you are still in control of your business. And the negative side is it takes time to accumulate money. That's why we need to plan. We need to have a proper planning, proper business plan. So we know we need to start saving money, if we're going to be opening business after 6 months or 1 year. And the cons, another is limits cash availability for emergencies or other needs. That's the money that if we use for our business, then maybe it's going to be shortage on our other, side that we were saving for. And the second reason is the equity investment by owner. That's the second source. Primary source for startup, early stage business, quick access to funds. The negative side is that it requires additional cash from owners, personal funds. It may create personal financial stress. So that's maybe the money that you have saved for your personal use, for your emergencies. Now you need to use it for your business. So you may have, some money problems, for your financial needs. So, and the third source is equity investment from external source. This is where you have a partnership, or maybe you have another investor that, they're trying to help you with the, with the funding, financing your business. So you have no repayment schedule and a potential industry experience and connection from investors. This is maybe the investor that is willing to not just give you the funding, but also their advice, right? Or their experience advice, which is good, right? So the the negative side is that owners may give up control and future profits. It's because you're having that, investor to, give up maybe percentage of your ownership for your business. And now they maybe have control, over your business also as well. Okay. So investors, they also are expecting a higher return. Another source is borrowing. So you could borrow money. Maybe it's the lowest cost from borrowing outside from your bankers, lenders, creditors. The owners retain control. So you're still control of your business because you're not giving up your ownership. You're not having shareholders. So your equity and profits, you're still in control. And the bad or the negative side is that you may not be available to get a loan for your business. It's because maybe it's a new business and you don't have a sufficient equity. Equity meaning your assets minus liabilities. And maybe it's the net assets or net worth is not sufficient to borrow money. And business personal assets, they might be at risk if the loan you got on your business, if it's not paid back. Okay, next one, please. So this is, again, it's a template that you could use for your business. So which is best for your business? What strategies you're going to be using? Are you going to be, using your cash reserves that you've been saving? Or is it just going to be your equity, that money that you retained from your business to, like in your profit, right? As that you've been retaining as your profit, and or is it just going to be borrowing? You're going to be borrowing money from your bankers or lenders. So how much do you have in business cash reserves? So if you do, maybe you want to write down how much you have so you know how much you need more. So what plans do you have to use them? The money that you have in your cash reserves. So what plans do you have to use them? Do your profit support reinvestment in the business? So if you have a business and you're trying to have another one, is your profit is gonna help you to buy the next business? And many businesses, they do that. They open small business and then to expand that, they use their profit plus they leverage debt to buy another business. So does your current cash flow meet your need? So how much you have, is it gonna be enough? Are you gonna be needing financing? What plan have you made to secure more equity? Who will provide it? Is it, investor, your owner? I mean, as an owner, are you gonna be providing all that financing? Are you gonna be having investors? How much debt do you have now? So of course you need to write down how much you owe right now. So do you have plans to borrow more? And if you do, how much? Okay, let's go to the next one. Thank you, Tom. So select the right type of financing. We talked more, about like this is going more in details, how to select the right type of financing. So you can see over here 3 columns. One is the business credit card. The second one is the business loan. The third one is business line of credit. So we're going to talk about, for each one in detail. So business credit card, it's best for everyday purchases. Maybe you could be purchasing your, supplies for your business, maybe inventories for your business if it's a retail store, right? So you could earn rewards based on spending. And it's a very short-term borrowing. A lot of business owners, who travel a lot for their businesses, they get mileage cards, credit card. So they can earn mileage and they travel for free. So how do you access funds? It's available up to a limit and it tied to a card for purchases. May be able to transfer balance for a fee. You maybe have a credit card that you've been paying, maybe average credit card balance, they pay like 16-17%. And maybe you have a credit card that you're paying 16%, maybe you have another one you're paying 20%, and then you received a new offer that you have a 0% for 18 months. We all are aware about that, right? So you take advantage of that, instead of paying 15% or 20%, you have multiple cards. You can transfer balance, I think as about 3%. I think as I know, but I'm not sure, but you can ask more about your credit card company. So you could transfer balance. How do you payment work? So they set up a minimum payment monthly. So if you're not able to pay the whole thing, and that is the best way to utilize your credit cards, you pay minimum amount and incur interest charges. Of course, they're going to charge you interest rates, right? They're going to charge you some credit card charge really high interest. So be careful, or pay entire balance to avoid interest. So even you have a credit card that you transfer funds, transfer balances, you want to make sure that you pay within the time that they give you. If they give you 6-month promotional, you want to pay within 6 months. If they give you 18 months, you want to pay within 18 months. Because if you don't, then they will charge interest rate on the whole amount that you borrowed. The interest rates. The interest rates typically they are variable. Sometimes you get a promotional card, you're getting only 7% interest rate. But if you miss miss twice, payments, they maybe will jump your interest rate to 28%. So you have no control on interest rates because it's not fixed. And collateral, typically, there is not a collateral required, but the credit card companies, they look for your income, that you're going to be able to pay the premium, the payment, and they look for your job security and all those things. They still look for your credits, right? So you can check if you have this or you're going to apply for one, then you can check this box. And let's go to the second one, business loan. So it's a great for financing major purchase or one-time cash needs. So how do you access funds? Of course, you need to apply. Once you apply your funds at one time, after the loan closes, you will receive all the funds. How do payments work? So it's it's the balance that you borrowed or the money that you borrowed. So they will set up your payment plan. Maybe it's for 10 years or maybe it's for 20 years or 5-6 years usually, right? And then as you pay, your balance will go down, right? So interest rates, typically they're fixed interest rates. So when you close your loan, and collateral, it can be secured or not unsecured. So they may want to look at your collateral, your business income that it's generating sales, your net income, of course, your other things that like your homes, your bank accounts. So they maybe want to see that. So for the larger loans, you may need collateral. So you can check if you have that. If you don't have it, then are you going to need this? So for the future, I think it's good to know what options are available out there. And the third one is business line of credit. This is based on your business. You have a business that's running already. Maybe you need money for seasonal cash flow. And how you access, you of course you apply for it. You're available to draw up to your credit line limit. How you access will depend on your lender. And lenders may offer, interest only payments or a percentage of the balance plus interest. So it depends on the lender and depends what type of business you have. So you have like a different type of options. And interest rates, they are also variable. And collateral can be secured or unsecured. So larger loan sizes typically require collaterals. And checking, if you have it or if you don't have, are you going to need this? So you can also, check on this. And then also on the right side, you can see that there are more other options. So instead of buying stuff, you can lease, right? It allows the business to use the property owned by the lessor. So may have an option for the user to purchase the property. So often used for commercial real estates. So we can lease, right, office equipment and business vehicles. And this other, reason or the, different type is the construction loan. Let's say that you're you're in the construction business. You're trying to build maybe 100 apartments, right? So for that, it's a type of real estate loans where the balance increases as the project is completed until a point where the loan is paid off or converted into a commercial mortgage. So it's like a special type of loan that you can, start, and then it's gonna go different routes as the construction project completes. Another thing is the Small Business Administration, the SBA. It's a, they guaranteed loans. So it's a type of financing offered by lenders where the SBA guarantees a portion of the loan, often a way for borrowers to obtain longer terms or flexible funding if they do not meet conventional borrower qualifications. So that's a great, actually, if you have a good credit scores, your banker is maybe not willing to take 100% of the risk. So that's where the SBA comes. They will guarantee your loan. So your banks can give you the funds. Okay, let's go to the next one. Okay, so these are more sources, funding sources. So we can, this is going to be also in detail. So right now we can see there is a Department of Community and Economic Development, and there is a credit, I think, Community Development Financial Institutions, Equity Investors, Family and Friends. Of course, that's my favorite one. Online lenders, FinTech, peer-to-peer crowdfunding, Department of Agriculture and Rural Developments. So these are different type of sources that we could be utilizing to borrow money. Okay, so let's go to the next one, please. Okay, so we talk more in details the funding sources, right? So family and friends. So family and friends, like I said, it's my favorite one because your family, they want you to be succeed, right? So you can also, obtain financing or funding from your family. That's the best way. So may offer lower interest rates and more flexible repayment terms. So because they understand you better, so it's flexible with your family. But the thing is, it can also add strain to family and friends relationships. It's because if you said that you will pay in 1 month or you will pay in 1 year and you don't pay it back, you're not even picking up their phones, that's where it becomes problems. Then you ruin the relationship with your families or your friends. Okay, so that's why we have to be very careful when we borrow from our loved ones. And the second option is this, we talked about the equity investors. This is some of the examples are angel investors. That's very common these days, venture capitalism, and outside investors. So they provide funds in exchange for ownership, share in the business. So this is where you're giving up percentage of your business. You're giving up the ownership. So typically you have no payments. Investors are seeking a share of the profit and proceeds from any ownership sale. Some investors are experienced business owners, so they may provide some good advice how you can grow your business, and they give you input about your business decisions. So you have other people giving you advice on your business, and which they also have interest in your business, right? Because they own your business now too. So finding the right investors, it can take a long time. It involved process because you don't just give other person to own your business or get the funding from them. You want to investigate, you want to find out, do your due diligence on the person that is giving you funding, but also taking ownership for your company. And the third one is the community development financial institutions. They typically serve community businesses, which are small businesses, micro enterprises, nonprofit organizations, commercial real estate, and affordable housing. So they have a financing for businesses that spark job growth and employee retention in hard to serve markets. So they also are, for small business owners, they're trying to help them to grow, in the particular, community that they are in. So tailored for smaller and early stage businesses. Okay, and let's go to the next one. Thank you. So more, funding sources, online lenders. These are fast growing. They make decisions very fast on loans and quick funding. Predictable monthly payments, more lenient on credit criteria with less documentation required. But the thing is, they may charge very high interest rates and may be difficult to find for large loan amounts. Maybe they're willing to give you small amount, but not big amount. So also it's online lenders. So we have to be very careful, right? When we're dealing anything that we can't, we don't physically see that. So we want to make sure there is no scam going on when we do online lenders. So another one is peer-to-peer lending sites. There are like a funding circle up. These are some examples. So you can borrowers with lower credit ratings may qualify, may offer lower interest rates than other options. It's a fast application processing. You have no interaction between lenders and borrowers. So they are just giving you fund. They're not just going to take over your business. So you don't, you are, still in control of your business. And some things that you need to consider it's mostly used for personal loans, but growing use now they are using for small business loans. It may require substantial personal information to determine loan eligibility. So you may need to give lots of your information to apply for this loan. And the another source is crowdfunding. And that's my second favorite one. So these have, these are examples. Kickstarter, Fundable. These are some of the examples. I know there are lots of them, but these are just few. So they work best for funding new products. They require an excellent marketing campaign and social media savvy. And it's it's because it's online thing. So we have to know good, like how we use the technology, the social media platform, and a minimum cost to try, but considerable time investment. Even though there is a minimum cost to apply, but it takes lots of time. So time is more, that investment over here that you need to put a lot of time in order to find out the best crowdfunding, for your business. Fintech is, it refers to companies that use advanced technologies to improve financial decision making. It encompasses a wide range of financial service from mobile payment apps to online lenders. So this is something new. I don't know too much about it, but I believe this is more for the companies who are technology, based. It may be easier to get your loan approved by a fintech company, but interest rates may be higher and the loans may be due sooner. So it's based on the terms and conditions. Fintechs offers various financial opportunities. Okay, so let's go to the next one. Okay, so this is the last one for the funding sources. So like we mentioned, the SBA, it guaranteed loans through banks. So a percentage of loan is guaranteed by the Small Business Administration. Now the banks are more willing to take a risk on your business because they have insured, right, by the SBA for the loan that they're giving you. So Department of Community and Economic Development. So this is a special category for people who are local lenders. They're trying to improve their local economic development programs. So they may be offering financing assistance for small businesses. And then last one is the Department of Agriculture and Rural Development Service. So if you're located in a rural area or starting an agricultural based business, there may be special loan programs available to help you. And SBA also has loans targeting rural entrepreneurs. Okay, to the next one. Okay, so now this is again, it's a template that you could use, and you want to write what funding sources or lending products you're gonna think your business may need in the future. So because it's very important for us to know, what our business is doing right now, and in the future, if I want to expand my business, what are the options to expand, right? And leveraging that, that's the best way to grow your business. Yeah. Let's go to the next one. Okay. So some of these sources of capital, I know there's not too much over here, but we talked a lot about, different sources of requiring funds for your business. So these are few, number of websites that you could use. SBA guaranteed loans, that's the website, the www.sba.gov. Federal government grants, that's the second website that you could use to explore your opportunities, explore your options for your business. www.grants.gov. And so we, it's very interesting that, when we start business, we think that we're not going to need a lot. When we start going more into the business planning, expanding our business, then we realize that, yes, I need maybe 100,000 or 200,000. So that's where we want to have a proper solid business plan. So we know how much we're going to be needing money, right? So we could be prepared, ahead. So because the thing is, a lot of businesses, they are successful, but they also, they can fail because if they don't have good financial backup for their business, then we can see that what happens in the COVID. There are a lot of business companies, restaurants, they were out of business because they did not have a proper financial plan for their backup plan for their business. Okay. And now, I want to thank you so much for your time. And I will, I will ask Michael Moore to take up and talk more about what bankers, creditors, they look for details when you apply for a loan. Okay. Thank you. Thank you.
Thank you, Jaspreet. As she mentioned, I would like to talk a little bit about what is really primarily a bank-focused discussion about the sorts of credit that might be available in the banks. So let's take them one by one. Accounts receivable financing is just what it sounds like. They make you a loan. It's based on the amount of receivables that you have, which are invoices that haven't been paid yet, but the bank is willing to pay or provide funds based on their expectation that you're going to be paid. I want to point out, factoring is something entirely different. In factoring, you actually sell your receivables to another company. They take over the collection. They charge hefty fees, but sometimes a startup, and you have receivables, well, that's the money you can get. A bank line of credit is basically, or is the most generic bread and butter product that banks have. You usually get it for a year at a time. It may be renewable after 1 or 2 years, and typically the bank wants to maintain a relationship. So don't be worried that there's a maturity date that's coming up. You're going to be having discussions with them about what is looking, or what the business is looking like for the next year. And they'll make their decisions once again based on that. Equipment leasing, not very many banks offer this, although some do. You're more likely to get it from a vendor of heavy equipment, or say large trucks, or even automobiles. So basically, they own the asset. You make payments at the end. If it's a financing lease, and that's a particular term, you may own the property, or you may own the asset. It's different from when you lease a building. You never get the building, you just pay monthly rent. So both are leases, but different types. Chattel mortgages is another way of saying getting a loan based on the value of the assets of your business. You may have assets other than accounts receivable, say inventory or the equipment, or even intellectual property, or a variety of other things. But chattel refers to taking a security interest, the bank taking a security interest in that asset in order to provide funds to you. I want to mention too, I'm going to talk about a plant improvement loan. These always are good things. If you're increasing production, then the increased cash flow may serve to provide the repayment source of your loan, which is good. Or you may simply be improving the operations such that, again, the savings create more cash flow, again, providing a source of repayment for your loan. The conditional sales contract, I believe it's rather rare these days, but essentially somebody is engaged in making a sale, but the asset continues to belong to them, and they make the loan based on that, and the expectation is that at the conclusion that will be paid. Next slide, please. Lenders and banks look for things that you would ordinarily expect. They want you and your business to have good credit. And there are different credit reports for businesses than there are for people, but they will look both. They want to see management expertise and commitment. They want to know that you're committed, that you're an investor, that you've been there, that you have good managerial responsibility capabilities. They want to see that you have a feasible business plan. It can't be something where you're suddenly I'm going to make $1 million next month. That's never going to work. They want to see that your business plan makes sense, both in the timing, the additional funds needed, and the profits that it's going to generate. They'll also look to make sure that you have an investment in the business. The banks are not interested in taking more risk than you're willing to take. So they typically will measure this with a variety of ratios, which we may discuss later. But essentially, your investment in the business needs to be there. Sufficient collateral, of course, is always important in a bank loan. Typically, a business pledges its assets to the bank in return for credit accommodations. Next slide, please. The 6 C's of credit. These are easy things to remember. Just memorize the list and you got it made. Good character. They want to make sure that you are at least not ill-regarded in your community. They will also check your references, or they'll look at your payables, for example, because those are the people, the suppliers that you owe money to. Are you keeping them current? Are you making sure they get paid on time? It's important. They want to make sure that you have the capacity. In other words, you can handle this debt. Your business can handle it, and you can back it up individually if need be. You want to make sure there's collateral. We discussed that before. Capital / owner's equity, they're all the same thing. Conditions is something that the bank adds in order to make it attractive to them in the underwriting process. There might be ratio requirements. There might be limitations on the amount, say with a line of credit, that you can get. Those are things they will decide. And of course, you'll always be signing their documents. So it's important to read them for all the conditions. Cash flow is critical because cash flow is what pays loans. And cash flow can be not just your profits, but other items that change and move on the balance sheet as well. Next slide, please. As to character, of course, trustworthiness. They want to make sure they can trust you with their money. Because once that money goes out the door, they have no idea what's going on. I'm being a little bit facetious there, but I think you get my point. Personal business credit, we discussed. Your integrity. It's kind of a hard thing to manage, but as the old saying goes, I know it when I see it. Quality of references. It's always very valuable to a bank if you come in being referred by a CPA that they know, an attorney they know, one of their own customers that refers you. Those are the kind of references you want to be able to bring to the discussion. Your experience in the business is critical. You can't simply just start something up and get a loan right away. They want to know that you know how this business works, how the industry works, and how it will make money. And of course, the impression you make on the lender or investor, just like anything, make a good impression because you only get one chance to make a first impression, and that one's very important. Next slide, please. They'll want to know, in reference to capacity, is your company able to pay the amount that you're going to borrow? And hopefully, your projections will demonstrate that over time, it will generate the funds that are needed to do that. That goes right into the next one about how soon can you be showing positive cash flow. When will you show a profit? How large will that profit be? And can the profit be sustained? These are all important aspects of the same thing, profitability. They want to make sure you are going to be profitable and you can demonstrate it to them with your projections. Next slide, please. Capital, of course, is the money that you have personally invested in this business. And going forward, your ability to save and accumulate profits in the owner's equity category of your balance sheet. Because as a business grows, of course, there's going to be more liabilities. They want the profits, a proportion of the profits to be maintained to make sure that there's an adequate equity cushion going forward. Next slide, please. Conditions. Now, I mentioned these as something that the bank adds during its underwriting and structuring of the loan. And your first experience with this will be when you're negotiating with the banker, who will say things like, well, we'd like to require profitability annually. We'd like to require a margin on your receivables. And you two are going to have that discussion and end up with something that's agreeable to both. But they'll also want to make sure that they understand your purpose. Why are you getting this loan? They want to make sure that the amount requested makes sense, both for the size of your business and for the purposes that you're going to put the money to. The length of the loan. As I mentioned, a business line of credit typically has a 1-year maturity, but the bank is interested in continuing a relationship because that's actually how they make money. They don't have to spend new marketing money every year. You're already there. So, and if you've maintained their library of financial statements on them, it should be easy. Next slide, please. Other forms of security always come into play. Banks refer to this as a secondary source of repayment. Ideally, it's an independent source of repayment. Things like a third-party guarantee, similar to when dad or mom signed off on your first auto loan. It's the idea. They're responsible if you don't or will not pay it. Important to make sure that the person who's on board with you there understands what you're doing as well. Tangible assets, this generally refers to things that are easily liquidated. Receivables is the most obvious. The bank finds you in default, they can take those assets and sell them. Same with your inventory. But that's only if you found yourself in trouble. But the definition of tangible assets is basically assets that can be liquidated by the bank if it needs to. Property, that's fairly obvious. Same thing with equipment. Receivables we talked about. Inventory is important also. Banks will give you a haircut on the value of that inventory if they're using that as part of their lending formula. But as long as everything's working okay, that should not create a problem for you. Next slide, please. When we talk about cash flow, generally we're talking about the money that is going to be generated by the ongoing operations of the business. So the answer to that first question is fairly obvious. Where's the money coming to repay the debt obligation? From the cash flow generated by the business. That's why they ask for projections in their financial statements. They want to prove to themselves that you can actually generate that cash flow. The question about where all the money will go really relates to, is it going to be reinvested in assets for the business? Is it going to go to dividends or payments to the owners? Or is it going to be retained, which is what they'd rather see in the business to make sure that there's always a cushion. And of the cushion, that cushion that they're referring to generally refers to the amount of cash that you're going to maintain or easily liquefiable assets. You want to make sure you're always ready for any surprises in the business. Next slide, please. Credit scores are very important. Some people are surprised to know that the bank wants to know their credit position as well as that of the business. You're all one and the same as far as the bank is concerned. You are the business. So that's why it's important. I can't emphasize enough the value of this connection here, annualcreditreport.com. Easy to use, easy to get. There's a few additional fees you can pay to get enhanced versions, but this is a great place to start to see where you stand. Next slide, please. What bankers want? Well, what we're talking about here is a package. What package are you going to take to the bank? What are you going to present to them? Cover letter of introduction should basically describe, here's what I'm doing, here's what I'm going to need, here's the funding that I already have, here's the funding I'm asking from the bank, here's why I believe it will be successful. It's a pitch, you know, here's how we're going to do this, and you bank, you're going to make money by lending money to me. Summary of financial needs, of course, is going to be important. Your financial statements, your business tax returns, your projected cash flow statement, because that's, you can show your history, but now we want to know where are you going? And that's the purpose of these projections. You want to identify to them the collateral that isn't going to be available. And remember, I mentioned that they're looking at you as well as the business. This is why they want your personal tax returns and your personal financial statements. They will have a form, a personal financial statement form that they want you to sign. The reason they want you to sign their form is there are certain requirements that you're agreeing to when you provide that information. They'll also want to have you provide a resume because you want to be able to demonstrate what your experience has been, which leads you to believe that you'll be successful with this business. They'll also want to know if you have any legal claims. Are you the subject of any lawsuits or judgments? That's going to be a matter of determining, or that matter will be determinant of whether or not there's any bumps in the road ahead. Are any of these assets pledged? We've had people come to us and say, well, we want to borrow the money. We've got these securities. And then we find out, well, they've got a margin loan on the securities. Well, that's not going to help us because somebody else has a prior claim on that. Want to make sure your taxes are up to date. Life insurance is important. Difference between face value and cash value. Sometimes that's very confusing. Term loan, a term debt, a term life policy. It's just going to pay out the face value if something untoward happens to you. Cash value refers to other sorts of policies where, like a whole life policy, where there's a cash buildup in the policy. So that can sometimes be lendable. And they'll want to know about your monthly household expenses. And to some degree, they'll just use a formula to calculate that. So I wouldn't worry about putting together a detailed budget, but have a rough idea. Next slide, please. Okay, meeting the banker, getting your foot in the door. And that part is important. I already referred to. You can go into a bank and ask for the commercial loan officer. There's nothing wrong with that. But they'll want to know your characterization of what is known as the SWOT analysis. What are your strengths? What are the weaknesses? What are the opportunities? And what are the threats? A lot of people become very nervous talking about weaknesses or threats to their business. The bank expects you to know what they are and how you will deal with them. It's not just a listing of, well, I might go out of business because of this. You might say, okay, we're concerned about this. Here's how we're mitigating the risk. That's important. And of course, down here in the strengths, this is what you want to talk about in your elevator speech, and a short presentation should you be called upon to do one. Next slide, please. The borrowing process. There's several steps to it. First of all, you need to figure out what it is that you need. You're going to go to the bank and you're going to not only provide your package, but you'll fill out an application too, which a lot of times is the personal financial statement that I referred to earlier. If the loan officer is in agreement and you two are generally agreeable on what the terms will be, it goes to underwriting. Underwriting can change some of the things that the banker, the friendly, happy banker, may have agreed to. The decision will be made either by a senior loan officer or a committee, and you'll want to find that out. How will you approve my loan if it's going to be approved? Processing, the next step is there may be things like if you're pledging real estate assets, there may be appraisals required. If you're pledging accounts receivable assets, there will likely be an audit requirement. All these sort of things where a third party comes in and sets a value that the bank can then rely on in their underwriting process. The closing is pretty simple. The good day is here. You're going to get the money. Come on down and sign your loan documents. And then the funding will take place usually 1 or 2 days later. Now, the real fun begins for the bank because they start getting repayments from you. And that'll be tracked and you'll be billed and probably debited out of your business account just to keep things simple. Next slide, please. After your financing decision, you want to make sure that you're in place and you've got the loan. Make your payments on time, maybe even a few days ahead of time, just for fun. Address any business issues or deficits that could keep you from securing credit, and build a track record of sales and profit growth and loan repayment integrity to make sure that when it comes time to renew that facility, that they have a good feeling about you. And continue to build the equity value of your business. That means you don't just take the profits and go out and buy that new car. You keep at least a portion of it in the business to build up that equity cushion in support of your enterprise. Next slide, please. The important thing that we're going to talk about here is you can put your business in a position to get the funds you need in the future, which is kind of what I've been referring to. Have a good track record with them, and that'll smooth the way when it comes time to renew the loan. Borrowing requests, to drive a meaningful business outcome. Borrowing, along with equity and cash reserves, are the primary sources of your money. The best type of financing for your business depends on your situation. You're going to decide that long before you go into the bank. Lenders focus on those 6 C's, 6 considerations: character, capacity, conditions, collateral, and cash flow. You need to understand the borrowing process so you don't get disappointed when there's a time glitch, or they come back to you with additional questions, or they want to change what you and the friendly banker agreed to in his office. And you want to make sure that you put your profile in writing, which is part of your package, part of your reference material, to help you and a lender understand the fine points of your business and what the borrowing needs will be. Next slide, please. Okay, I think from here, I'm turning it over to Tom. Tom, wrap it up and bring it home.
Thank you, Mike. That was a great presentation. Thank you, Jaspreet, for all
Thank you.
that great information. Here's where we've been. Startup basics, business concept, marketing plan, financial matters, funding options. This was our last class. We're going to see you more. We're going to see you in our future classes. We're going to see you in our mentoring sessions. But we encourage you to keep working on all of this. Work on this small business readiness assessment. We've been introducing these assessments to you over and over again, but this will be helpful to you in meeting with your mentor and continuing with your no-go or go decision. Your idea feasibility, your market identification, your implementation, your funding, your personal readiness. I won't go over that point by point with you. I encourage you to take it and look at it very carefully and give an honest answer, because you're really just answering to yourself. I want to congratulate you. You've completed Simple Steps for Starting Your Business series. And this is what you've learned. And if you've missed any sessions, you can go onto our website. You can register for those sessions, and you can take them in an asynchronous way. You can make them up. If you have any trouble figuring out how to do that, all you got to do is figure out how to apply for your mentor. And in a few days, you can have a conference, and we can help you get that information. A lot of resources. Our manual, I think we've got it updated on that website now, but we have a number of resources, the exercises, the handouts, the workshop materials, anything you might have missed at www.score.org/start-your-business. We want to see you at the next breakout session. We actually, even though we've completed the class, we're going to have a breakout session to help you with your homework. Our round table graduates are going to be there. We're going to all be there. I mean, you are our graduates. We're going to work with you on anything you need to wrap up in terms of homework. And that's where you'll be receiving your completion certificates. So hope to see you November 14th at 10 a.m. and you can register with that link. We can help you. We can help you research your idea, complete your feasibility plan, finalize your financial forecast, develop your business plan, prepare your loan package. We can hold your hand while you do that. We can't do the work for you, but we can be there for you and to help you in the launching your new business and celebrating that. and growing your business. A lot of people will come back to us with a new challenge or a new opportunity. They want to launch a new product, or they want to launch a new marketing initiative, and we're there for you for that. We wish you the very best. We want you to succeed. So I hope that this very week you'll set up a meeting with your mentor. If you have a mentor and you know you've lost contact, you've fulfilled your goal, maybe it's time to get back in touch and set up another meeting. Help others by completing an evaluation. And then ask SCORE for advice online, or email SCORE, or check your website, our local website, centralvalley.score.org. We always want you to know about the public library, especially the downtown library in Fresno, and the online library as a source for a great deal of business information that you would otherwise have to pay a lot of money for. And then we have tools and templates. But again, I want to come back to, there's nothing like a relationship with your one-on-one mentor. We have an exit poll for you, and we really appreciate your participation in that before we get to the questions and answers. So we're going to launch that poll right now. Was today's information relevant and useful to you? Did you get something that you can use? Were the facilitators knowledgeable about the subject? And then finally, would you recommend SCORE to a friend? And we'll give you just a moment to finish that, and then we'll get to our questions. And we have several that are lining up in the queue. Okay, the results are 100, 100, 100, and 100%. Thank you for all those wonderful yeses. And I'm going to invite our panel to come back on with their faces and their voices, and we're going to start tackling the questions. There was a question, now understood that the follow-up was that this was answered, but I'm going to go back to it again and just because Jaspreet is the one that answered it the first time, and there may be some, by the way, I want to welcome one of our newest volunteers, Lisa Schwartz, with us, is up in the mountains, and we're glad you're here. We want to, Michael, would you weigh in on this, asking others to invest in your business by showing them your business plan?
Well, sure. I'm going to talk about this, but before we leave that subject, I want to go to Lisa, and I hope she'll be comfortable in sharing her own experience there. The important thing to remember is there's got to be an agreement that both of you put together about how the money's going to come in, and what that person who may or may not be active in the business, what role are they going to play? Are they simply going to give you money? That's doubtful. They're either going to want payments, they're going to want some involvement in the business, they're going to want some percentage of the business, or you may want to have a profit sharing. The interesting thing is there's any number of ways that this can go, but for the money to come in, there has to be an incentive. For there to be an incentive, there has to be a successful business. So part of it is in looking for this person, you want them to have some expertise. It'd be great if they can provide the money and some brain power to cover things that you haven't done yet or are unfamiliar with. And I know that Lisa is somebody who has experienced this in her own life as a coffee shop operator. And Lisa, if you wouldn't mind, you unmute yourself and share with us your details.
Sure. That was a really good presentation, and I took advantage of a lot of the items on the list. So I did have a significant amount of owner equity that I sunk into the business, saved up retirement funds, basically. I had initially had a business partner who also made an equal financial contribution into the business. And then I had business credit cards that we used for day-to-day expenses that were a little bit beyond the cash flow of the business, but we always made a point to pay them off every month because I was not comfortable having a lot of debt early on. We got to a point where we wanted to do a pretty significant expansion of the business, but it was a coffee shop and coffee roasting company, basically. We outgrew the space that we were in, and we had an opportunity to move into the suite next door and move all our production and packaging and shipping into the suite next door. And that was a very large financial commitment. So I got a SBA-backed business loan through US Bank to finance the business expansion, and with a 5-year repayment plan. And then I also had a personal loan from a very good friend. So I've taken advantage of a lot of those, but I can say with the loan from the very good friend, we separated our friendship from the business, and we did everything by the book. And we had a promissory note. We recorded a lien against equipment in the business to secure the loan, because neither one of us wanted to risk our friendship with any kind of trickiness about, is a loan going to be repaid on time? So that was a limited term loan, which I did end up being able to pay back earlier than anticipated. So we did it all.
Boy, that is a great testimonial of how you've used a lot of sources.
Thank you, Lisa.
Yeah.
This question came up. What if you get a no? What do you do with a no? From you go to the bank and you get a no, or you go to SBA and get a no, you go to somebody and get a no. You stop, you quit, you regroup, you ask certain questions of the person that's telling you no. What should my strategy be with my first no?
Well, I think the immediate response, as soon as the word no is from out of their lips, why? What is the problem? Identify the issue for me. Help me to be a better or have a better credit profile by telling me exactly what the problem is. And, because I want to work on this. And there is such a thing as lender fatigue, but we'll get to that later. The important thing is to find out where the issue is, so that you can then concentrate on addressing that, either sometimes with either more collateral, another guarantee, or make a change in the business plan in some way. But your goal is getting the funds in, and people shouldn't be married to the way they thought the business should be, because your business has got to be acceptable to the bank if you want money from the bank.
Super. And then you may want to investigate some of the other sources, but you certainly want to
That
get
too.
in there and fix what's wrong. I want to address this one to Jaspreet. Jaspreet, you work with a lot of families. You work with a lot of people that do personal financial planning. Should I fund my business with my credit card?
Yes, I believe it's it's very convenient to use credit card for your business, because you could buy inventory, supplies. You can use your credit card for that. But there are a lot of things that we have to know, using credit cards. So number one is that, yes, when we apply for a credit card, they're going to look at our credit score. So based on that, they will give us the, good interest rate, or like very high interest rates. So we want to make sure that we are having good credit score. So that takes time to build your credit score. So before we launch a business, before we even think about business, we need to work on our personal credit score, because the better our credit score is, the more chances that we will qualify for different type of loans. So credit card is, of course, one of it. The things that we have to be careful, is the interest rate. What is the interest rate that I will be paying, if I use that for my business? So with that, where we can plan that, before we pay the like 20% interest rate, or 30%, sometimes it's 28%, if you miss a payment. So we want to make sure that we are not getting into a trap of, just like, with fees. overdraft fees, if we go our, credit line limit, that's those fees, the late fees. So we just need to keep good track of the credit cards if we're going to use that for the business. Thank
You
you.
really want to be very, very careful, and you really want that at the bottom of your list. It's a great thing for cash flow and for immediate purchases. I have a question I think I'm going to try to answer, even though I'm not the best qualified, but I'm going to take the easiest one because I'm going to give you a vague answer. How good must my personal and business credit scores be to secure financing? And that the answer is, it depends on a number of factors. For instance, if you want to look at a very specific answer to that, you can go to one of the SBA lender front offices like Access Plus Capital. It'll tell you right up front what kind of credit scores for what kinds of loans. It will depend on the size of the loan. It will depend on the term of the loan and a number of things. There are some loans that you can get, and I'm not advocating that you aim for, scores in the 600s, but there are loans that you can get with scores in the 600s. Probably none of the loans that if you had gone to Michael's bank, but through SBA and through other sources. So you don't want to necessarily get discouraged and say, I can't get a loan just because your credit score is 700 or something like that. With a nod, is that pretty much the answer to that question?
Yeah, I think you've got it. There's more flexibility than people expect on the other side of the desk at the bank. If they really want to make the loan, okay, I see your credit, but what else can we do on the other side of the discussion? Could you provide other collateral? Could you provide a guarantee? Could you do this? Could you borrow less? There's a variety of ways to cut the suit to fit person.
Yeah. So don't be your own knower. I mean, don't be the one that says no to yourself.
Yeah.
Talk to somebody, get your stuff together, get your facts together, get your story together, get your pitch together, get all these documents together that this panel has told you about, and try and get with your score mentor to help give you some assessment. But don't pre-program the no into your brain. I'll throw this out to whoever wants to answer it. What happens when I need more funding? Is it easier to get the next round of funding?
Well, let me just say, having been there many times, it's a fairly common situation. And probably the simplest one is, say somebody says, well, I have to pay all this money back in a year on this line of credit. I could point out to them, no, a line of credit really represents a relationship. Take care of that relationship, make your payments on time, give them your financial statements as you are required, be profitable, make money. They will want to renew it for another year because that's the most efficient way a bank can make loans, and they want to make loans. So there's that. How else would I answer that? The other thing I would say, let's say somebody's in a business and it takes off. It goes really well. Okay, I'm back at the bank now. This is turning out much better than I thought, and I'm going to need to get more money. And there'll be some concern because, number one, how come you didn't know that? And number two, okay, once again, can you support it? But I've worked on many loan packages where, okay, we'll take a look at it. What's happening here? And do your projections show that this will continue? Or do you need a seasonal bump in your line of credit? It all depends, again, really back to the basics here. How long do you need this money? Why do you need this money? When can you repay it? If it's a short-term bump, like a seasonal, let's say even an agricultural type situation, okay, we'll lend you this money. We see you're going to sell the crop out here. We're all going to get paid. Great. On the other hand, wow, I can see your business has really taken off. Looks like that industry is doing well. Yeah, let's take a look at increasing it. We don't want to lose you as a customer because that means I would have wasted all my time and the bank's money. trying to make a loan, but there'll
So that's
always be a
scaling.
sympathetic ear.
That scaling up sounds a lot better than me coming in and saying, you know what? I misjudged the cost by $100,000. That doesn't
Oh,
look
yeah.
too, good, does it?
Well, it's you're absolutely right. It's how you frame it. You know,
Yeah,
we have an opportunity here. You
Yeah.
could be.
you can get in on it.
Yeah.
Do we have any other questions coming up? Anybody thought of any while they were being asked?
Let me just, not a question, but let me make a point, particularly for small businesses. The community bank where you are is going to be, if you don't know anybody, that's your best place to start. The community bank is part of the community. They want to be seen as helping the small business community. That's the world they want to be in. And it's also a place where you can get to know more than just a few people. I always tell people who are borrowing, okay, you know your loan officer. Have you met his boss? Meet his boss. Make sure his boss knows you. And if you can get away with it, meet the boss's boss. Somehow, it's a small world. We can all talk. I'll meet you at the Elks Club. We'll, oh, aren't you the senior lender over at such and such bank? Yeah, I just got a loan from you. How are you doing? You know, this sort of thing. It's important to know those people so that you have more than one voice to talk to or one source of assistance should you need it.
And you get to know them the day you walk in to open your checking account.
Of
You
course,
start the process.
might be a little much, but you know, you can't exactly demand meetings, but it's better to have them happen.
Well, you've met a banker,
Oh yeah, well,
usually a business banker, right?
right.
Thank you, everybody. I have some more questions that have come in. We primed the pump.
Good.
This is a question for Michael. Michael the
Okay.
banker is a very popular person on here today. Michael, what does a bank need to see in terms of composition of capital, owner's salary, down payment, owner's equity for a loan of $500,000?
Well, that's awfully tough to answer without knowing the full details of the business. Let me just say composition of capital. Composition of capital. I would say generally if you're starting or if you have a business, they don't want to see your leverage, as we call it, go up more than 2 or 3 to 1. And what that means is $2 or $3 of liability to every dollar of capital that's in the business. So that's one aspect. Down payment, it sounds to me like something's being purchased here. That all depends. Again, the banking lending equation is very fluid. You might say, well, I need 100% down, but I've got these financial statements that show that I've generated lots of cash flow and that my coverage will be very good. A bank usually wants to see about 1.25 to 1.5 dollars in cash flow over the loan payment amount. Okay, so that's a ratio to do. So I can't really relate all that back to a specific loan for 500,000, but I hope that those parameters help a little bit.
Yeah. Yeah, we can't get too much more specific than that because, like you say, it's fluid.
But we don't know.
Yeah. Do you recommend credit unions? Sure, right? How about you, Mike?
Okay, I'll answer that one.
Except credit unions don't usually make business loans. A lot
Exactly. Although they've gotten credit unions, you know, they started out as assisting the employees of large companies who couldn't make it into town to do their banking, and that was all fine. I have a certain feeling about credit unions. It may come out, but in recent years, they've started to jump into areas where, let's just say, I'm surprised. One of them has been commercial real estate, and you will find them. It's a fluid world, so you never know when they're going to be granted powers to do something else. But frankly, you will find the depth of expertise in a commercial bank.
Yeah, right. And most people come away from credit union. Well, they said they can't do it. So
Yeah,
the
there's
answer
the problem.
Anything else, folks? We know that it's time for your lunch.
Yeah, what are we having today, Tom?
Well, I have to go in and look.
I haven't got all day. Come on.
As my wife used to say, she got it from her mother. Whenever they said, "What's for dinner, Mom?" Food. Thank you, everybody. Lisa, welcome to the fold. We look forward to seeing everyone. Our calendar is posted on centralvalley.score.org. And we'll look forward to seeing you guys Monday. I think Monday is the 14th. And all the best, everybody.
Okay.
Our crew is going to